Well, the Federal Reserve this past week did what it said it had planned to do, approve a 1/4% increase in the prime lending rate. That means it will cost more for a mortgage and to finance a car. What does the rate hike say about the state of our economy? Well, back with us this morning is Dr. Gus Faucher. He's chief economist for PNC Financial Services Group. Gus, welcome back to the show. It's always good to have you on here. You know, I guess this wasn't unexpected, but if I understand correctly, this is the third time in 6 months that the Federal Reserve has raised this interest rate. What's going on here?
That's right. So we had a period where rates were basically near zero from 2009 through the end of 2015. And since then, the Fed has been gradually raising rates. What they're saying is the job market is in good shape. The unemployment rate is 4.3%. They're worried that rising wages will lead businesses to raise prices. So they're concerned about inflation getting a little bit higher. So in an effort to cool the economy down just a little bit, they're raising rates very, very slowly from a very low level.
But is there any real sign that the inflation rate is going up much? I mean, I thought it was still at 2% levels.
Yeah, it's actually gone down a little bit over the past few months. But the Fed is forward-looking. What they're saying is, hey, the unemployment rate is getting close to 4%. We are seeing wage pressures gradually develop. And what they don't want to have happen is they don't want to have inflation heat up all of a sudden, and then they need to raise rates very quickly. So this way they do it gradually, and the hope is that'll cool off the labor market a little and prevent inflation from overheating.
So what does all this mean to us as average consumers out there? Does this really hike all the interest rates that we have to pay on credit cards and mortgages and car loans and the like?
It depends on what kind of loan it is. So short-term interest rates, so things like credit cards, home equity lines of credit, those are going to go up basically one for one. So if the Fed raises its rate by 1/4 percentage point, those types of rates are going to go up by 1/4 percentage point. For longer term interest rates, particularly mortgage rates, they don't respond much. They're much more dependent on what's going on with global bond markets, with what the federal government is doing in terms of borrowing, that type of thing. So mortgage rates are, don't really respond to this, and in fact, mortgage rates are very low right now. In that respect, it's a good time to borrow and buy a home if you can afford it.
So just to parse this a little bit, what the Federal Reserve is doing is essentially going to raise the interest rates on our credit cards, right? And on car loans as well?
To some extent, probably not as much one for one. At a shorter term rate, it's going to go up a little bit more than like a 3-year loan will go up more than a 7-year loan, that type of thing. And then also business loans as well. So they may, short-term business loans, they may see their cost to borrow go up.
Well, Gus, I can't have you on the show without asking you about your general view of the economy as we go midway through 2017. How do you think this year is panning out so far?
This year is looking good. It's not fantastic, but I think it's looking pretty good. So the economy continues to add jobs at a pretty steady clip. In fact, the big complaint I get from employers now is that they would like to hire, but they're having difficulty in finding workers. Yes. And that's part of those wage pressures we were talking about.
Yeah, we've done stories on that. There's no doubt that a lot of folks are just not trained for the kinds of jobs that we have. Everybody thinks they need to get a 4-year college degree when in fact they don't, and we need to be doing more to direct our young people into professions that a certificate or a 2-year training program will qualify them for a job. So that's part of what the wage pressure is, I take it.
That's right. So businesses are having difficulty finding workers, and so for some of those occupations, they're bidding up wages. But we are seeing pretty steady job growth. The unemployment rate is at 4.3%, so that's a very good, solid number.
How about Pittsburgh compared to the nation?
In Pittsburgh, a little bit behind the rest of the U.S. And I think in part that's because the labor shortages are a bigger problem here than they are in other parts of the country. So we tend to have an older population, and so that means that we don't have as many young people coming in that businesses are looking for. So that's part of it. I mean, obviously we have a lot of tech hiring here, but those
every time I suggest that to certain folks in town, they get upset. I mean, they believe that we are bringing lots of younger people into Pittsburgh.
We are, but we can always do better with that. And then also I think we've been hurt by the downturn in energy prices. So the big drop in natural gas prices we've seen over the past 3 or 4 years, obviously, it's starting to pick back up again, but we just don't have the level of activity that we did a few years ago. And so that's been a slight drag on growth in the Pittsburgh area.
So as you look forward to towards the end of this year, do you think 2017 is going to be a net positive year in lots of ways?
Yeah, I think 2017 is going to look like, 2015, 2016. So the economy looks pretty similar to what we've had over the past few years, which is okay growth, not a booming economy, but steady job gains, rising wages, and that's good news for consumer spending, improving housing market, and just general overall economic improvement.
Yeah, good. Final question in the limited time we have. Will the Federal Reserve be raising rates again, a fourth time, sometime in the next 3 or 4 months?
I think we will see another rate increase from the Fed at some point later this year. The other thing the Fed is trying to do is they have a lot of money on their balance sheet that they put on it during the financial crisis and the response to that. So they're going to try to reduce that. That's going to interact with the short-term rate increases.
Sort of buy back money?
Yeah, yes, that's basically what they're trying to do. And so they may do that, let's say start that up in September, so they may hold off on a rate increase then and then raise rates again in December. So I'd expect to see one rate increase this year and then maybe another 3 in 2018.
Wow. Well, then bottom line is pay off your credit card debt, everybody.
Yes,
because
that's right.
The interest rates are going up, and they're going to go up and up and up.
That's correct.
Dr. Gus Faucher, always a pleasure to have you on our show. Thank you so much for being with us today.
Thank you, John.
We appreciate it. When the Sunday Business Page continues, historic state pension reform is signed into law in Harrisburg. So what will it mean for state employees?